Are you sabotaging your own retirement without even realizing it? What if I told you that the biggest threat to your financial future isn't market crashes, inflation, or even unexpected expenses, but rather 7 simple mistakes that millions of people make with their 401k every single day? These aren't obscure financial blunders that require a PhD in economics to understand. These are basic errors that cost ordinary people hundreds of thousands of dollars over their working careers, and the tragic part is that most of them are completely preventable, and I help people navigate the often confusing world of personal finance and investing. If you're interested in securing your financial future and avoiding costly retirement mistakes, make sure to subscribe to the channel and hit the like button if this information proves helpful. Here's something that might shock you. According to recent studies, the average American loses more than $200,000 in potential retirement savings due to preventable 401k mistakes. That's not a typo. We're talking about enough money to buy a house, fund a child's college education, or provide years of comfortable retirement income. Yet most people have no idea they're making these errors, and even worse, many financial advisors fail to address these fundamental issues with their clients. The 401k system was supposed to democratize retirement savings, giving every working American access to the same wealth building tools that were once reserved for the wealthy. In many ways, it has succeeded. Millions of people have built substantial nest eggs through consistent 401k contributions over decades. But the system also created new opportunities for costly mistakes, and unfortunately, the people making these errors are often the ones who can least afford them. What makes these mistakes so dangerous isn't just their financial impact, it's the fact that they compound over time, meaning small errors made early in your career can cost you exponentially more by the time you retire. The person who makes a seemingly minor mistake at age 25 might discover at age 65 that this single error cost them more than their annual salary. The mathematics of compound growth work both ways, magnifying not only your smart decisions but also your poor ones. Before we dive into the specific mistakes, let me ask you something. When you first signed up for your company's 401k plan, how much time did you spend researching your options? If you're like most people, you probably spent about as much time choosing your retirement investments as you do picking what to watch you on Netflix, maybe selected a few funds that sounded reasonable, set your contribution percentage, and then forgot about it completely. This casual approach to one of the most important financial decisions of your life is exactly how these costly mistakes happen. The first mistake that's costing people enormous amounts of money is not contributing enough to capture the full employer match. This might sound basic, but you'd be amazed how many people leave free money on the table every single year. Your employer match is essentially a guaranteed return on your investment, yet according to financial industry data, roughly 1 in 4 eligible employees fails to contribute enough to receive their full match. Think about this for a moment. If your employer offers to match 50 cents for every dollar you contribute up to 6% of your salary, and you're only contributing 3%, you're literally refusing free money. This isn't like declining a store discount or passing up a promotional offer. This is your employer offering to immediately double a portion of your retirement contributions, and you're saying, no, thank you. Let's put some real numbers to this mistake. Imagine you earn $50,000 annually and your employer offers a 50% match on contributions up to 6% of your salary. If you contribute the full 6%, that's $3,000 from you and $1,500 from your employer, totaling $4,500 going into your retirement account each year. But if you only contribute 3%, you're getting $1,500 from yourself and only $750 from your employer, missing out on $750 in free money annually. Over a 30-year career, assuming reasonable investment returns, that missed employer match could cost you well over $100,000 in retirement savings. And remember, this is money your employer was willing to give you. You just had to ask for it by contributing enough to qualify for the full match. What's particularly frustrating about this mistake is how easily preventable it is. Unlike trying to time the market or picking winning stocks, capturing your full employer match requires no special knowledge or skill. You simply need to contribute enough of your own money to trigger the maximum employer contribution. It's like having a coupon that doubles your money, and all you have to do is remember to use it. The second major mistake people make is treating their 401k like a savings account instead of an investment account. This error typically manifests in two ways. Either people leave their contributions sitting in cash or money market funds, or they choose extremely conservative investments that barely keep pace with inflation. I understand the psychology behind this mistake. Investing can feel risky, especially when you're dealing with money you're counting on for retirement. Market volatility is real, and watching your account balance fluctuate can be nerve-wracking, but here's what many people don't realize. Not investing is actually the riskier choice when you have decades until retirement. Money sitting in cash or ultra-conservative investments faces a different kind of risk called purchasing power risk. While your account balance might not fluctuate much, inflation is quietly eroding the value of every dollar you're not investing. What seems like the safe choice today could leave you significantly short of your retirement goals 30 years from now. Consider this example. If you contribute $300 monthly to your 401k, but leave it all in a money market fund earning 2% annually, after 30 years, you'll have accumulated about $130,000. That might sound reasonable until you realize that the same $300 monthly invested in a diversified stock portfolio earning 8% annually would have grown to over $400,000. The difference between these two approaches is more than $250,000, all because of the fear of short-term market volatility. The third mistake that's quietly destroying retirement dreams is paying excessive fees without even realizing it. This is perhaps the most insidious error because it's largely invisible to most investors. You won't receive a bill for investment fees. Instead, they're quietly deducted from your returns year after year, steadily reducing your wealth accumulation. Many 401k plans offer dozens of investment options, and the fees on these options can vary dramatically. Some funds charge less than 0.1% annually, while others charge more than 1.5% for essentially the same underlying investments. This might not sound like a big difference, but over decades, these fee differentials compound into enormous sums. Here's a real-world example that illustrates this point perfectly. Two identical investors each contribute $500 monthly to their 401k plans for 30 years. Both earn the same underlying investment returns before fees. However, one investor chooses low-cost index funds with fees averaging 0.1% annually, while the other selects actively managed funds charging 1.2% in fees. After 30 years, the investor who chose low-cost funds will have accumulated roughly $100,000 more than the investor who paid higher fees. Think about that for a moment. $100,000 in additional retirement wealth simply from being more careful about investment fees. That's enough money to fund years of retirement, several, or leave a substantial legacy for your children. Yet, most people spend more time researching which smartphone to buy than they do investigating the fees in their 401k plan. The fee problem becomes even more complex when you consider that higher fees don't necessarily mean better performance. In fact, numerous academic studies have shown that lower cost funds tend to outperform higher cost funds over the long term, primarily because they have less of a fee drag on returns. You're often paying more money for inferior results, which is exactly the opposite of what you want in any purchasing decision. The fourth mistake that's silently sabotaging retirement accounts across America is the dreaded loan trap. Yes, most 401k plans allow you to borrow against your own retirement savings, and yes, technically you're paying yourself back with interest. But just because you can do something doesn't mean you should. And 401k loans are a perfect example of a feature that sounds helpful but often creates more problems than it solves. Here's how the psychology typically works. You need money for a home down payment, debt consolidation, or some other expense. You look at your 401k balance and think, this is my money anyway, So why not borrow it instead of getting a traditional loan? After all, you'll be paying interest to yourself rather than to a bank. It seems like a brilliant financial hack until you understand what's really happening behind the scenes. When you take a 401k loan, you're removing money from your investment account during what could be crucial growth periods. That money is no longer earning compound returns in the market. Instead, it's earning whatever interest rate you're paying yourself, which is typically much lower than historical stock market returns. You're essentially forcing your retirement money to accept below market returns for the duration of the loan. But the real danger comes if you leave your job while you have an outstanding 401k loan. Most plans require you to repay the entire loan balance within 60 days of separation. If you can't come up with the money, which most people can't, the outstanding loan balance becomes a distribution. This means you'll owe income taxes on the entire amount, plus a 10% early withdrawal penalty if you're under 59 and a half years old. Imagine borrowing $20,000 from your 401k and then unexpectedly losing your job or deciding to change careers. Suddenly, you owe not just the $20,000, but also income taxes and penalties that could easily total another $7,000 or more. What started as a convenient way to access your own money has turned into a financial nightmare that could take years to recover from. The fifth mistake is perhaps the most emotionally driven error people make with their 401k accounts, and it has to do with market timing. When markets are soaring, people feel invincible and want to contribute more. When markets are crashing, they panic and either stop contributing or worse, move everything to cash. This pattern of behavior is so common that it has its own name in financial circles, buying high and selling low, which is literally the opposite of successful investing. The irony is that market downturns are actually the best times to be investing in your 401k. When stock prices are lower, your contributions buy more shares. When prices recover, those additional shares you purchased during the downturn generate outsized returns. But human psychology works against us here. When everyone around us is panicking about the economy, it takes enormous discipline to continue investing as if nothing has changed. I've seen people make this mistake repeatedly throughout different market cycles. During the 2008 financial crisis, many investors stopped contributing to their 401k plans or moved their money to conservative investments right at the market bottom. Those who stayed the course and continued investing through that difficult period saw tremendous returns as markets recovered over the following years. The key insight here is that market volatility is not a bug in the investment system. It's a feature. Volatility creates opportunities for long-term investors to accumulate shares at discounted prices. When you're investing regularly through payroll deductions, you're automatically taking advantage of dollar cost averaging, which smooths out the impact of market fluctuations over time. The sixth mistake involves a fundamental misunderstanding of how 401k accounts work across different jobs throughout your career. Many people treat each job change as a complete reset of their retirement planning, making costly decisions about old 401k accounts that can severely impact their long-term wealth accumulation. When you leave a job, you typically have four options for your existing 401k balance. You can leave it with your former employer, roll it over to your new employer's plan, roll it into an individual retirement account, or cash it out. Unfortunately, too many people choose the last option, especially when the account balance seems relatively small. Cashing out your 401k when you change jobs is one of the most expensive financial mistakes you can make. Not only do you owe income taxes on the entire distribution, but you also face a 10% early withdrawal penalty if you're under 59 and a half. Even worse, you're removing money from your retirement savings during the years when compound growth has the most time to work its magic. Let's say you're 30 years old and change jobs, leaving behind a 401k with $15,000. It might be tempting to cash out that account to pay off some debt or make a large purchase. After taxes and penalties, you might receive around $10,000, but if you had left that $15,000 invested for 35 more years, earning 8% annually, it would have grown to over $200,000 by the time you retire. Think about that trade-off. You're essentially selling $200,000 of future retirement security for $10,000 of immediate cash. When you frame it that way, cashing out your 401k starts to look like one of the worst financial decisions you could possibly make. The seventh and perhaps most devastating mistake is simply not starting early enough. This error is particularly tragic because it's often made by people who think they're being responsible by waiting until they're financially stable before beginning to save for retirement. The problem is that waiting even a few years can cost you hundreds of thousands of dollars in lost compound growth. The mathematics of compound interest are both beautiful and brutal. Beautiful because they can turn modest contributions into substantial wealth over time. Brutal because they severely punish those who start late. A person who begins investing at age 25 will accumulate significantly more wealth than someone who starts at age 35, even if the later starter contributes more money each month. Consider two investors. Sarah starts contributing $200 monthly to her 401k at age 25 and continues for 10 years, then stops completely. Mike waits until age 35 to start, but contributes $300 monthly for 30 years until retirement. Despite contributing $90,000 more than Sarah, Mike will actually have less money at retirement because Sarah had the advantage of 10 additional years of compound growth. This scenario illustrates why time is your most valuable asset when it comes to retirement planning. You can always earn more money to increase your contributions, but you can never buy back time. Every year you delay starting your 401k is a year of potential compound growth that you'll never recover, no matter how much you contribute later. The psychological impact of delaying your 401k contributions goes beyond just the mathematical disadvantage. When you're forced to start investing to contribute much larger amounts to try to catch up, which can strain your budget and make retirement saving feel overwhelming. This often leads to what I call the retirement anxiety spiral, where people become so stressed about being behind that they either contribute too little because they think it won't matter, or they swing to the opposite extreme and try to contribute amounts they can't sustain. I've met people in their 40s who discovered they needed to save 40%, 30%, or of their income to retire comfortably simply because they spent their 20s and 30s thinking retirement was too far away to worry about. Suddenly, retirement planning transforms from a manageable part of your financial life into an emergency that dominates every budgeting decision. It's like trying to cram for a final exam that lasts 40 years. The cruel irony is that the people who delay starting their 401k are often the same ones who are most concerned about financial security. They want to pay off student loans first, or build up an emergency fund, or wait until they get that next promotion. These aren't unreasonable goals, but perfectionism becomes the enemy of progress when it comes to retirement planning. You don't need to have your entire financial life sorted out before you start contributing to your 401k. You just need to start. Now, here's where things get particularly interesting from a behavioral standpoint. These 7 mistakes don't occur in isolation. They tend to compound each other in ways that create even more dramatic wealth destruction. The person who doesn't capture their full employer match is also likely to be the person who keeps their money in conservative investments and pays high fees without realizing it. The individual who takes 401k loans is often the same one who cashes out their account when changing jobs. This clustering effect happens because all of these mistakes stem from the same root cause, a fundamental lack of understanding about how 401k accounts actually work and why the decisions you make early in your career have such massive long-term consequences. Most people receive virtually no education about retirement planning beyond the basic enrollment meeting when they start a new job. They're expected to make complex financial decisions that will impact the next 40 years of their lives based on a 20-minute presentation and a stack of confusing paperwork. The financial services industry hasn't exactly made things easier. Investment options are often presented with jargon-filled descriptions that would challenge even experienced investors. Fee structures are buried in lengthy prospectuses that nobody reads. Performance data is presented in ways that make it difficult to compare options. It's almost as if the system was designed to confuse people into making suboptimal choices. But here's what I find most frustrating about this entire situation. Every single one of these mistakes is completely preventable with just a basic understanding of how retirement investing works. We're not talking about complex trading strategies or exotic investment vehicles. These are fundamental principles that anyone can learn and implement, regardless of their income level or educational background. The person making $50,000 annually can avoid these mistakes just as easily as someone earning $200,000. In fact, avoiding these errors is arguably more important for people with modest incomes because they have less room for financial mistakes throughout their careers. When you don't have the luxury of high earnings to compensate for poor investment decisions, getting the basics right becomes absolutely critical. These 7 mistakes have cost Americans collectively billions of dollars in lost retirement wealth. But the beautiful thing is that now you know exactly what to avoid. Start capturing that employer match tomorrow, invest for growth instead of hiding in cash, keep those fees low, resist the loan temptation, stay invested through market chaos, never cash out when changing jobs, and most importantly, start today rather than waiting for the perfect moment. Your future self will thank you for taking action now. And honestly, your future self deserves a comfortable retirement after putting up with all your questionable decisions over the years.